Today, you're going to hear about portfolio rebalancing and this topic, asset allocation, because these two topics work hand in hand. Now, right now, maybe your portfolio has built up to a sizable amount already. Maybe you've followed some of my suggestions in dollar cost averaging, and from $1,000, you have built a $100,000 pot. Now, right now, this pot definitely needs some work in terms of adjustments, correct? Today, I'll share with you pointers that you should take note of, and I'll give you 5 important points to look out for. So if you're keen, continue watching on. Hi guys, welcome back. Now to start things with, let's address this topic of asset allocation. Asset allocation simply means how much of a percent of this asset do you have. So this is actually a chart by DBS. It's mentioned that on average, Singapore households have 41.7% in property, 19.9% in currency and fixed deposits, now that's certainly too much, only 9.2% in stocks, 10.1% in life insurance, and 18.5% in CPF, which is Singapore's pension scheme. Now you can see your assets in totality, and if you do that, that gives you a bit more holistic point of view. Because if you look at it closely, your life insurance, your deposits, your CPF, which is Singapore's pension, especially if you are overseas and not too familiar with this term, these are all safe assets. And if you have substantial amounts of these, does that mean that you can be more aggressive with your financial portfolio? That is a pointer to take note of. But usually when we talk about asset allocation, in terms of portfolio, we are talking about only the financial instruments. So to simplify things, asset allocation is how you divide between stocks, bonds, and cash. Now everybody do know that stocks or equities as a broad basket does the best over time. And maybe even cryptos can be doing even better in 10 years time. Nobody knows for sure. But when it comes to asset allocation, it's not just the reward. It's a balance between risk and reward. Or you can see it in a different light, which is balancing whether you can sleep well on it and to getting your financial goals. Because if you have everything that is in cash and fixed deposits, you cannot get to your financial goals. On the other hand, if you have everything in equities, you may not sleep well. So once you understand asset allocation, the next part is about portfolio rebalancing. And portfolio rebalancing, to put it in simple terms, is to make changes to adjust the portfolio back to its targeted asset allocation. That's why we have to address what exactly is asset allocation first. This portfolio rebalancing could be done annually, or it could be done semi-annually. But with market volatility these days, on my own, I actually practice for myself and my private clients to do quarterly rebalancing. Now, if the target is 60% equities and 40% bonds, as you know, equities, if it goes up, the component of equities could rise due to market value to 70% and 30% bonds left. So that's where portfolio rebalancing is to actually sell down the equities and tilt it back to 60-40. Conversely, in the bear market right now, in equities, the equity component could drop to 50% of the portfolio. That's where you want to sell the bonds and buy equities to tilt it back up to 60%. Now, there's a key critic point to bring up in this discussion also. Rebalancing is inconsistent with a buy and hold strategy, correct? You are actually changing positions. And that's why I do not believe on doing rebalancing on a monthly basis. That is just too much of trading. But on the other hand, the key benefit is quite obvious also. You're actually selling high and buying low. Now that is what I'm more inclined to believe in. That's why I still practice asset allocation and portfolio rebalancing. So with that clarified, let me share with you more details on how to construct your portfolio. And before I get there, help me smash your like button if you benefited from this message, and share this with anyone who should see how to manage their own portfolios a bit better. So without further ado, let's touch on the first tip for today, which is to understand correlation and diversification. Take a look at this chart over here. It shows how correlated certain asset classes are. The first one on top is core equity, then non-traditional equity, which includes REITs, and then US investment grade bonds, non-traditional bonds, commodities, and cash. Actually, this list can extend even further, but let's drive back the key point in this chart, which is to show you that at this point of measurement, some asset classes don't correlate to the others that strongly. You see that if you have US large cap stocks, you should also buy things such as non-traditional equities, which includes REITs, into the portfolio. You should add some bonds and some commodities in because they are in the blue bar segment. They are about the lowest correlation to a large cap equity. And you know I've been an advocate for commodities for quite a while. And I guess it's blue in this category simply because it's not done well in the last 10 years when everything has been skyrocketing in terms of valuations quite a bit. Now the key part is this. When you combine different asset classes that are loosely correlated, you actually get a better risk-adjusted return. This has been proven through data already. The only question is we are looking at backward data. We're not looking in terms of forward, because moving forward, some assets might start to correlate for a certain period in time. And that's where the art of proper investment really comes into play. Because black swan events happen. Take for example now, there is war happening in Ukraine. Take for example interest rate hike that is happening right now in US and most recently in Europe also. And as a last point, when it comes to diversification, if you buy Apple stock and Amazon stock, there is actually very little diversification because they are both US large cap and they are both US tech. But if you buy Apple stock and DBS stock, that's where you get a slightly more diversified approach, even though they are both equities. Tip number 2. This is a myth, 100 minus age rule for equity allocation. Now some people even use 110 minus age as a rule. Let me explain what does this 100 rule minus age actually mean when it comes to equity allocation. It means that, for example, if you are age of 80, you should only have 100 minus 80, which is 20% in equity and then 80% in bonds. Conversely, if you are 20 years old now, you should have 100 minus 20, which is 80% in equity and 20% in bonds. Quite simply, this is nonsense. I don't know what is the research paper behind it, but in any case, this only factors in age to risk appetite. It does not factor in goals, it does not factor in experience, which are very important in my opinion when it comes to buying what kind of assets into your portfolio. Take for example, a 20-year-old newbie to the investment market shouldn't be too aggressive because there's very little experience in markets up and downs. There's bound to be mistakes to be made. Therefore, putting 80% in equities, I would like to challenge that notion also. Conversely, someone who is 80 years old and has seen multiple equity cycles, why can't that person be big into equities? You should check out Warren Buffett. He's all about buying stocks. What about for Charlie Munger? He's closing on 100 years old. Does that mean that he should be fully into bonds? I do not think so. So I do believe that this 100 minus age equity allocation is a myth that should not be followed. Tip number 3, which is extrapolation for tip number 2, is to understand what you have bought. Because that is very likely the best way to understand the risk of the investment they have made. And just to not deviate too far, there is actually no best asset allocation method. There's no one fixed template for any particular group of people. But let me play a clip from Warren Buffett to really elaborate on key points.
Stocks and 40% in bonds, and a big announcement now we're moving at 65-35, 60-40 or 65-30. It just doesn't make any sense.
Now let me elaborate on what has been played so far. He's trying to emphasize more on understanding what you have bought. You do not adjust your asset allocation due to news. It shouldn't be risk on, buy equities, risk off, sell equities. It doesn't work that way. You should adjust your asset allocation based on, in my opinion, valuations. Previously, technology was a small allocation in my portfolio. And when it falls for a certain period, it will be at some point looking attractive. That is where I increase the allocations towards technology. Make sense? So again, do not change the asset allocation based on market noise, but rather take advantage of opportunities in terms of valuations. Tip number 4 is to not be overconfident with your asset allocation. The key question is, are you too much into a particular sector, not just a particular stock? For my own, I try to cap each and every stock holding to less than 20% of the total portfolio. I've actually shared this before on this channel. But if you look in terms of Berkshire Hathaway, they actually have 38.8% allocated into Apple. Now, Warren Buffett is of course wise. So why is he doing so? I think it's probably more in line with let your winners run. That's good. And more crucially, as an institution, it's not easy for him to move positions. Whereas for us retail, we can actually move positions very easily. So for myself, I've moved away from PropNex, I shared on this channel before, and moved towards commodities. Right now, commodities form about 30% of my entire asset allocation. And if we look in terms of Berkshire Hathaway's allocation, you realize that Chevron and Occidental Corporation, which are both oil and gas players, now form 11% of the total portfolio. This has been where Warren Buffett has been buying quite massively. So again, it's a point where I would like to suggest commodities are increasingly looking like a valuable part of your portfolio. If you're not sure on which stock to buy, go with a broad-based energy index, for example, and keep it as a small allocation. Hopefully, if oil prices stay high, that could be an outperforming segment for you. So a key rounding point on this chapter is never go all in one particular company. If you value your financial freedom, your family's financial freedom, above bragging rights, it's not worth putting all your eggs in one basket. And with that, let's move on to the 5th tip for today, which is buying a portfolio or a fund that can automatically do the portfolio rebalancing for you. the key benefit of outsourcing this to a fund or portfolio is that you are less emotional on what to make in terms of decision. There is a disciplined approach to executing this on a regular basis. So the first fund I'd like to suggest is actually a dimensional global allocation 60-40 portfolio. I've actually covered this in a previous video. I'll leave links towards the end of this tutorial also. You realize that dimensional global allocation 60-40 portfolio gets you more than 14,000 holdings. And within it, you see equities, US core equity, which is 31.1%, and you also see fixed income. So one fund breaks down broadly into equities and bonds for you. But the thing is this, if you are buying US stocks yourself, then this said fund has a lot of US allocation. Then the correlation in performance between this fund and your US stocks is going to be quite high. But then if you buy Singapore stocks yourself, then maybe this fund can be a value add to your portfolio because it gives you different assets. I have a second suggestion to show you, which is an actively managed fund. This is First Sentier Bridge Fund. At this moment, the top allocations are HDFC Bank and Taiwan Semiconductor. Equity allocations are biggest to China, and as of current moment, the total equity weightage is actually slightly less than 50%. Now, I've actually followed this fund for quite a long while, and in previous years, for example in 2014, India used to be the biggest allocation, and total equity exposure was more than 50% back then. So this is actually a balanced fund that can give you a broad-based approach to large cap equities in Asia and also bonds. If you buy US stocks, maybe this could be a good complement to things. So hopefully I've given you a lot of angles in what to look out for. And when it comes to financial freedom, your objective is to get there smoothly and with as much predictability as possible. And the best way is to do your asset allocation properly and review your portfolio to do rebalancing on a regular basis. As always, if you have questions, leave them in the comment sections. I'll pick them up for you further. Stay tuned because I'll be touching on an asset class that I have the biggest worry about. So if you're keen to find out on that, subscribe and stay tuned. With that, I'll sign off from here and invite you to some of my previous tutorials as promised. Invest safe as always. Take care and goodbye.